Hey everyone, welcome back to Corporate Decoder, the place where we untangle the messy world of corporate finance for you. And today we have a juicy one involving a big acquisition. I can tell you right now someone is getting bought out for quite a pretty penny buckle up because this is going to be good. Our story today is about One Biopharmaceuticals Incorporated entering into a major deal to acquire Mersana Therapeutics Incorporated. This Form 8K is all about that acquisition, and let me tell you, it reads like a business textbook. But we're going to break it down so it is as clear as day. So what is the big deal here? Basically, One Biopharmaceuticals is making a move to buy out Mersana Therapeutics. This is a merger agreement, and it is a pretty significant event for both companies, especially for Mersana's shareholders. The core of this filing is the agreement and plan of merger. One Biopharmaceuticals, as the parent company, and its little subsidiary Emerald Merger Sub Incorporated are joining forces with Mersana Therapeutics. This is not just a friendly handshake, it is a formal contract to combine their businesses. Here is where it gets interesting for Mersana's investors. One, through its subsidiary, is launching a tender offer. This means they're going directly to Mersana's shareholders, offering to buy all of their shares. The price is pretty sweet. Initially, it is $25 in cash for each share. But wait, there is more. On top of that cash offer, shareholders will also get what is called a contingent value, right, or CVR for each share they own. Think of a CVR as a promise for future payouts if certain milestones are met. These milestones are tied to the development and success of Mersana's drug amiltatug, also known as EMI. If Mersana hits these targets, shareholders could get up to an additional $30.25 per share in cash. That is a potential total payout of over $55 per share, which is a substantial premium over the current trading price for Mersana if everything pans out. After the tender offer, if enough shareholders agree to sell their shares day one, will then merge Mersana into its subsidiary. This process is designed to be smooth and speedy, allowing the deal to close without needing a full shareholder vote for the merger itself, which typically adds time and complexity. Now there are conditions to this deal. One of the most crucial is the minimum condition. One needs to get at least 50% plus one of Mersana's shares tendered in the offer. If they don't get enough shares, they can't be forced to go through with the acquisition, and this condition cannot be waived by One without Mersana's approval. Like most big mergers, this deal also needs approval from antitrust regulators. They have to file with the Hart-Scott-Rodino Antitrust Improvements Act and get the all clear before they can proceed. They are aiming to get this done within 6 months. What happens to the employees of Mersana? Well, their stock options and restricted stock units are also addressed. Some options with a lower exercise price will be cashed out. Others with a higher exercise price will be exercisable for a limited time after the deal closes. Restricted stock units will essentially be converted into the right to receive the merger consideration. Mersana can't just go out and look for a better offer from someone else. They've agreed to some pretty strict non-solicitation rules. They can't encourage or negotiate with other potential buyers unless it is a truly superior deal, and even then there are penalties involved like paying a termination fee. This fee is set at $5.6 million, which is a significant amount. To make sure this deal has a solid foundation, key people at Mersana are also on board. The company's directors and top executives, along with some major investment funds, have signed tender and support agreements. They've committed to tendering all their shares in the offer and voting in favor of the merger. These significant shareholders collectively own about 8.5% of Mersana's shares. Their commitment helps ensure the tender offer will meet that all-important minimum condition. Let's dive a bit deeper into these contingent value rights, or CVRs, because that is where a lot of the potential upside for Mersana shareholders lies. These CVRs are not tradable on stock exchanges, they are purely contractual rights to future payments. One of the first potential payments is triggered by the FDA granting breakthrough therapy designation for EMI by the end of 2027. If that happens, CVR holders get $1 per CVR. Another milestone involves a research collaboration agreement with Janssen Biotech Incorporated. If Mersana receives an $8 million milestone payment from Janssen by the end of 2026, CVR holders get $1.25 per CVR. There is also a payout for the first patient dosed in a major clinical trial for EMI for a specific type of cancer called adenoid cystic carcinoma type 1 by the end of 2027. That is worth $4 per CVR. A really big one is regulatory approval by the FDA for EMI for the treatment of ACC-1. If this happens by the end of 2030, CVR holders receive $9 per CVR. This is a major de-risking event and usually comes with a hefty payout. Then we have sales milestones. If cumulative net sales of EMI hit $100 million in any year by the end of 2032, CVR holders get $2 per CVR. These sales milestones continue to escalate, hitting $200 million by the end of 2035 for another $4 and $300 million by the end of 2037 for $6. There are also European sales milestones, including a payment if net sales in the European Union and the United Kingdom exceed $10 million by the end of 2030. And finally, a payout for the first commercial sale of Lee in Japan by the end of 2030. Taken together, these CVRs offer a significant upside potential for Mersana shareholders. It is a way for Day One to acknowledge the value of Mersana's pipeline and reward shareholders if those valuable drugs actually make it to market and generate revenue. On November 13th, 2025, just after the deal was announced, One Biopharmaceuticals put out a press release and some investor presentations. These documents give more context about the deal and its potential impact on Day One. They are essentially the company's way of communicating this major news to the public and investors. Now, as is standard practice in these filings, they include a whole section about forward-looking statements. This is basically a disclaimer stating that many of the statements made are predictions about the future, and that actual results could be very different due to various risks and uncertainties. They list things like regulatory approvals, competition, and integration challenges as potential hurdles. They are legally required to say this to protect themselves from lawsuits if things don't go as planned. This section details how investors can find more information. It highlights that the official offer to purchase and other documents will be filed with the SEC, and that investors should read them carefully. It also directs people to Mersana's website for further details. Finally, we get to the exhibits. This is like the appendix of the report where they attach all the actual agreements. We see the merger agreement, the tender and support agreements, and the contingent value rights agreement. These are the legal documents that lay out every single detail of the transaction. There are also press releases and investor presentations attached here. Now let's look at this deal from a bigger picture perspective. One Biopharmaceuticals is acquiring Mersana Therapeutics. This kind of move is typically made by companies looking to expand their pipeline and secure future growth. Mersana Therapeutics has a promising oncology pipeline, specifically with its drug candidate MEM. If Day One can successfully bring Lee to market and achieve those milestones outlined in the CVRs, this acquisition could be a huge win for them. The offer price itself, including the potential CVR payouts, represents a significant premium for Mersana shareholders. This suggests that Day One sees substantial value in Mersana's assets, particularly Lee's potential. The deal structure with a tender offer followed by a reverse merger is designed to be efficient. However, there are inherent risks. The success of this acquisition hinges on regulatory approvals, the ability to successfully integrate Mersana's operations, and most importantly, the clinical and commercial success of Lee. If Lee fails in clinical trials or doesn't gain market traction, the CVR payouts might never materialize and the value of the acquisition for Day One could be significantly diminished. The fact that key Mersana executives and major shareholders are supporting the deal with their tender and support agreements is a strong positive indicator. It shows confidence in the offer and a belief that this is a good outcome for Mersana. The termination fee of $5.6 million is a standard protective clause for Day One, ensuring that Mersana doesn't back out easily for a better offer. Overall, this filing tells a compelling story of strategic acquisition driven by the potential of a promising drug candidate. Day One is betting big on EMI. And if they win, it could be a transformative moment for the company. Mersana's shareholders are being offered a very attractive exit with the potential for even more upside through the CVRs. The key will be execution and the successful development and commercialization of Lee. Alright, that is our breakdown of this merger agreement. What is your take on this acquisition and the potential of these CVRs? Do you think Day One is getting a good deal? Let me know your thoughts in the comments below. If you found this analysis valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings like this. Don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching. See you next time.